once a year in my class at Columbia, at least for the last 5-6 years, somebody raises their hand and asked a question that goes something along the lines, something like this. Hey, Joel, congratulations. You've been doing this for 35 years. And you've had a nice record, but now there are more computers, there's more data, there's more ability to crunch numbers, and kind of isn't the party over for us? Isn't it just more hedge funds? There's just a lot more competition. Isn't the party over for us? So my students are generally second-year MBAs. I'd say average age 27 or so. So I just answer it this way. I tell them, let's go back to when you learned how to read. Let's take a look at the most followed market in the world. That would be the United States. Let's take a look at the most followed stocks within the most followed market in the world. Those would be the S&P 500 stocks. Let's take a look at what's happened since you learned how to read. So I tell them from 1997, when they were 9 or 10, to 2000, the S&P 500 doubled. From 2000 to 2002, it halved. From 2002 to 2007, it doubled. From 2007 to 2009, it halved. And from 2009 to today, it's roughly tripled, which is my way of telling them that people are still crazy. That was just the last 17 years. And I'm way understating the case because the S&P 500 is an average of 500 stocks. If you lift up the covers and look underneath what's going on, there's huge dispersion of those 500 stocks between those at any particular time that are in favor and those that are out of favor. And so there's a wild ride going underneath the covers. If you look under the covers, there's a wild ride of those 500 stocks at any particular time. And that doubling and halving with the average of 500 stocks is really smoothing the ride. So there should be an opportunity. And if you understand what stocks are, and I guarantee my students first day of class, I make a guarantee every year they walk in, and I guarantee them this. If they do good valuation work of a company, I guarantee them the market will agree with them. I just never tell them when. Could be a couple weeks, could be 2 or 3 years, but if they do good valuation work, the market will agree with them. Stocks are not pieces of paper that bounce up and down, and you put complicated ratios on, like Sharpe ratios or Sortino ratios. Stocks are ownership shares of businesses that you are valuing, and if so inclined, try to buy at a discount.